Welcome back to Midcap Radar. The market continues to remain quite choppy. The Nifty has given up significant gains, now down almost 140 points. But it's the broader end of the markets that are doing quite well. The Midcap Index continues to hold with minor gains of close to 0.4%. A couple of stocks that on our radar, first stock on the radar is Bharat Forge. The company came out with its results around an hour ago. The company also uploaded its presentations where the commentary that the company has given appears to be quite strong. They say that they continue to see profitable growth going forward, with commentary especially strong as far as the defense part of the business is concerned. What's actually tempered expectations is the overseas business, where exports have actually cooled off on a sequential basis. On the back of that, Bharat Forge and also Motherson Sumi too has seen a bit of a spike in the last hour of the trading session. But moving on, we'll now have to shift our focus to Godrej Consumer. The company reported its Q1 numbers and saw its net profit surge over 40% on a year-on-year basis, while revenue declined during the same period. To discuss this and more, we are now joined by Aasif Malbari, the CFO of Godrej Consumer Products. Mr. Malbari, welcome to the show. First up, tell us about the demand environment and the outlook for the entire year going forward.
We're quite happy with the way the quarter shaped up. In the beginning of the year, we had called out three key important deliverables for us. It was volume growth in India and Indonesia, and overall the shape of EBITDA growth. So when you look at the quarter which has gone by, we delivered an 8% organic underlying volume growth in India, 7% underlying volume growth in Indonesia, and an overall EBITDA growth of 13%. So all the right mixes went in. As we kind of are looking towards the end of the quarter and as the current quarter has begun, we are seeing some green shoots in terms of rural demand patterns, and hence we are quite hoping that we are able to kind of build on from the volume momentum which we've got. Another piece which is kind of spanning out is we are coming towards the end of the deflationary commodity scenario. Over the last few months, there has been mild inflation, which we're seeing across the board. And hence, going forward, we should actually see revenue growth being ahead of volume growth for us. So again, that should aid overall growth scenario.
All right, revenue growth ahead of volume growth. You've guided for 2 to 3% price growth along with, high single-digit volume growth this year itself. Let's talk about margins. This year, we did see some coming off in the margins in India, even as international margins saw marked improvement. So what's your margin band, Mr. Malbari, for this year?
I think, we've guided for this year saying that our aspiration would be to ensure that we deliver high teens EBITDA growth. And broadly, we are in track on that. The India EBITDA margins have been off by only 20 bips. We still delivered a very, very healthy shape of 25% EBITDA margins for the India business. But if you see the growth in EBITDA margins in the international business, we've actually kind of improved margins across all the businesses, Indonesia, GOM, and in LATAM. And hence, it's a I would say, more broad-based shape of margin improvement, which we've been able to deliver. And the idea would be to sustain EBITDA margins between a 25 to 27% band, while improving margins in the overseas business.
Okay, could you quantify the market share gains across the categories that you saw in the last quarter?
Personal wash, we've been gaining share over the last couple of years, and the last quarter is no different. That allows us to kind of deliver low single-digit volume growth in personal wash, but given the high penetrations, that's a good shape to be in. In other categories, again, our market development actions have been working well. So we have been gaining share in the hair color category. We've been gaining share in hair care. So overall, in most of our categories, we've not only been gaining share, but we're also focusing on market development and increasing the penetration, because these are still very nascent categories. And hence, both levers have been working quite well for us.
All right. One of those nascent categories that you're developing now would be, the deodorant category and sexual wellness that you have from Raymond, which is now at a 150 crore quarterly run rate. Now, you've given us your aspiration. Just wanted to know whether you're on target there. What's the revenue and margin target here? Because you scaled down some of the GT, inventory there.
quite happy with the synergy benefits which have flown into the business and hence the shape of the business in terms of margin profile. And we know that we've already kind of got the synergy benefits in the base, and hence the shape will be delivered as it is. We've done some actions in terms of portfolio simplifications and hence taken off around 10 to 15% of the revenue to kind of get it into a sharper portfolio as we now build distribution and growth. And hence, when you look at it from an optics point of view, while the numbers look similar, it's actually coming on a base which has been reset 15-20% lower. And hence, that's the kind of growth which we've delivered. So we're happy after kind of getting in the portfolio, looking at how we want to build it in the future. We're quite happy in the way it's kind of shaping up. It's a little bit slower in terms of absolute revenue compared to what one would have liked it. But when you factor in this simplification, it's come to a good shape.
That gives us a good sense of how the Raymond portfolio is shaping up. But what's your outlook for the international business? Especially, have you completed all of Africa's restructuring, and what is the target for the next couple coming of years?
So we've taken in and we've completed the larger part of the simplification. There are a few actions which are planned as we go along, which will fall in place, but the larger actions have been completed. And what we're now trying to focus on is running an efficient operation. So the last quarter, we've actually focused on bringing down the trade inventory. While offtakes are kind of going in line with plan, we've significantly reduced the trade inventory. Given that the interest rates in some of these countries is as high as 25 to 30%, it's in everybody's interest to operate with lower level of trade stocks. So that's what we focused on. But in spite of bringing down the turnover in the medium term, we've actually reshaped the business shape to a really good level. I mean, we were operating the Africa business at single-digit margins. The last 2 quarters, we've been able to bring it to a 14% margin shape and grown absolute profits also. So last quarter, actually, we saw a significant improvement in the margin profile across all our 3 international clusters. So we're quite happy with the way the profit shape is coming through.
All right. The biggie was the announcement that came in from the pet care side. 5,000 crore market growing at around 15%. You're looking to enter this. There are synergies with Godrej Agro as well. So the question that begets asking is, just the way Tata Consumer at some point, took over the consumer business of Tata Chemicals, would there be at some point, any sort of arrangement that would come by with Godrej Agro as well? They have the animal feed business. You're entering pet care. I'm just throwing that out in the open.
No, so I think to just keep things simple, firstly, we are very, very excited with entry into pet care. We've been working on this for the last year and a half, and we believe it's still a very, very nascent category in India, but it's large. It's a 5,000 crore category, and the opportunity over the next decade, it's quite large as it kind of grows at strong double digits over the next decade. As you said, we have a right to win as a group because Godrej Agro is India's largest animal feeds company. The structure is quite simple. We are going to be setting up a subsidiary company under GCPL, and hence all the risks and rewards are going to be in this company, which is going to be set under GCPL. And Agrovet is going to be the manufacturer and the R&D partner, and it's going to be an arm's length, co-packing contract with them. I mean, at this stage, the focus is on pet care and not onto the larger animal feeds business.
Could you give us a sense of the expected revenue and market share aspiration as far as the pet care business is concerned?
I think it's too premature for me to kind of call out an aspiration, but definitely in all categories which we enter, we look at being in one of the top players in the segment. So that definitely will be the aspiration. As we come more closer to the time of the launch with the mix, I think I'll kind of give a better guidance.
All right, a better guidance on pet care has been a very exciting category. Nestle entered it with Purina a couple of years ago. Then in the listed space itself, Mr. Malbari, we do have a couple of other companies as well, the likes of Cosmo First and even Rosary Bio. Thank you. Always a pleasure speaking with you. Wish you good luck for the remainder of this year. Before we slip into a short break, one word on the market. The Nifty has pared some of its losses. The Nifty banks, the one which is leading from the front, has now moved back into the green. But most importantly, we have a big surge that we're seeing on MRF. reported its numbers just about 15-20 minutes ago. A 17% revenue growth, the EBITDA growing by about 2% a lot better than what some of the other peers have reported, and as a result of which the big boy has moved big. Also, today's up move on the stock is nearly 7,600 rupees, taking the stock above that 1,42,000 mark. Take a short break, come back, get you more of the markets and a lot of individual stocks.